Investing. It's about making your money work for you. Instead of letting it sit in a savings account, you're aiming for it to grow over time. Think of it like planting a seed that blossoms into a tree. Here are the fundamental rules. No confusing terms, just straightforward steps to get you started. So, are you ready to turn your savings into something bigger? To watch your money grow and create opportunities for your future? Then keep watching. We've packed this video with valuable insights, and you won't want to miss what's coming next. Don't stop here. Watch until the end to unlock the secrets of smart investing and take the first step toward a brighter financial future. Let's grow your money together. Why bother investing? Investing helps your money grow faster than a savings account. It keeps you ahead of inflation, ensuring your money maintains its value. It builds wealth over time, like a seed growing into a tree. Investing provides financial security, acting as a safety net for your future. You don't need a lot of money to start investing. The most valuable investment is in yourself. Think about your skills and what you're good at. Investing in learning a new skill can have a huge payoff. For example, a $500 course could lead to freelance work or a new career path. Technical skills like coding and digital marketing are in high demand. The more valuable your skills, the more you can command in the job market. Think of your skills as personal assets. Investing in your skills can lead to increased earning potential. For example, transitioning from customer service to digital marketing. Practical experience enhances your skills and builds confidence. The best investment you can make is in yourself. Now, let's build a solid financial foundation. Start with an emergency fund, your financial safety net. Life is full of surprises, and an emergency fund protects you from unexpected costs. Aim for 3 to 6 months' worth of living expenses. Start small and gradually increase your savings. Having this safety net gives you confidence to pursue your financial goals. With an emergency fund in place, think about long-term growth. Understand your risk tolerance before diving into stocks and bonds. Risk tolerance is your capacity to handle investment fluctuations. It's a personal decision based on your financial goals and comfort level. If unsure, consult a financial advisor. Investing is a marathon, not a sprint. Set realistic financial goals and establish consistent investment habits. Identify your short-term, mid-term, and long-term goals. Write down your goals with a realistic time frame and amount needed. Start early and invest regularly, even if it's a small amount. Automate your investments to stay disciplined. Slow and steady wins the race in investing. Let's talk about compound interest, the eighth wonder of the world. It's earning interest on your initial investment, plus any accumulated interest. Imagine investing $1,000 with a 7% annual return. After the first year, you earn $70 in interest, making it $1,070. In the second year, you earn interest on $1,070, and so on. The longer you leave your investments, the more they benefit from compounding. Time is your greatest ally in investing. The earlier you start, the more time your money has to grow. Compare two investors. One starts at 25, the other at 35. The one who starts earlier accumulates more due to compound interest. The takeaway: start now and make consistent contributions. Even small amounts invested regularly can add up significantly over time. Many people believe they need a large sum of money to start investing, but that's simply not true. The beauty of investing is that even small, consistent contributions can grow significantly over time, creating a snowball effect that can lead to substantial wealth accumulation. Think of it like rolling a snowball down a hill. Initially, it's small and manageable, but as it rolls further, it picks up more snow, growing larger and larger. Similarly, when you invest consistently, even if it's just a small amount each month, your money starts to compound. As your investments generate returns, those returns are reinvested, generating even more returns, and so on. Over time, this snowball effect can turn even modest contributions into a substantial portfolio. Let's say you commit to investing $50 per week. That's $200 per month, or $2,400 per year. Assuming an average annual return of 7%, after 10 years, you would have invested a total of $24,000 and accumulated approximately $35,000. After 20 years, your investment would have grown to approximately $85,000, and after 30 years, it would have reached an impressive $185,000. This example demonstrates how consistent, even seemingly small, contributions can lead to significant wealth accumulation over time. The key takeaway is this: don't underestimate the power of small, consistent investments. Start where you are, with whatever you can afford, and make a commitment to invest regularly. Over time, the snowball effect of compound interest will work its magic, helping you build a solid financial foundation and achieve your financial goals. In the next section, we'll introduce you to some simple investment options that are suitable for beginners who are just starting their investing journey. Get ready to explore the world of low-cost index funds and other beginner-friendly investment vehicles. Starting simple, low-cost index funds. Now that you understand the importance of investing consistently, let's explore some simple investment options that are perfect for beginners. One of the most recommended and accessible options for new investors is investing in low-cost index funds. But what exactly are index funds, and why are they so highly regarded in the investment world? Imagine you want to invest in the stock market, but don't have the time or expertise to research and select individual stocks. That's where index funds come in. An index fund is like a basket of stocks that tracks a specific market index, such as the S&P 500. The S&P 500 is a market capitalization-weighted index of the 500 largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in the index. This diversification spreads your risk across multiple companies and sectors, reducing the impact of any single company's performance on your overall investment. Low-cost index funds are designed to track the performance of their respective indexes as closely as possible, charging minimal fees, known as expense ratios. These low fees allow you to keep more of your returns, further enhancing your investment growth over time. While stocks, particularly those held within index funds, are generally considered the workhorse of a long-term investment portfolio, it's also essential to understand another investment option: bonds. Bonds are often described as fixed income securities and can be a valuable addition to a diversified portfolio, especially for investors seeking lower risk options. In simple terms, imagine you're lending money to a borrower, such as a company or the government. That borrower issues you a bond, which is essentially an IOU that outlines the terms of the loan, including the interest rate you'll receive and the maturity date when you'll be repaid the principal amount you lent. Bonds typically offer lower potential returns than stocks, but they're also generally considered less risky. This makes them a suitable option for investors who are closer to retirement or have a lower risk tolerance. Bonds can provide a steady stream of income through interest payments and can help balance out the volatility of stocks in a portfolio. When choosing bonds, it's essential to consider factors such as the creditworthiness of the issuer, that is, the borrower, and the maturity date of the bond. Government bonds, for example, are generally considered less risky than corporate bonds, but they may also offer lower interest rates. Longer-term bonds typically offer higher interest rates than shorter-term bonds, but are also more sensitive to interest rate fluctuations. As always, it's advisable to consult with a financial advisor to determine the most suitable bond investments for your individual financial goals and risk tolerance. As your income grows and you become more comfortable with the basics of investing, it's time to level up your investment strategy by considering diversification. You've heard the saying, "Don't put all your eggs in one basket," right? Well, the same principle applies to investing. Diversification means spreading your money across different asset classes to reduce risk. Think of it like this. If you invest all your money in a single stock and that company performs poorly, your entire portfolio takes a hit. However, if you spread your investments across various asset classes, such as stocks, bonds, and real estate, a downturn in one area is less likely to significantly impact your overall portfolio. Diversification helps mitigate risk by ensuring that your investments aren't all correlated. When one asset class is performing poorly, another might be performing well, helping to balance out your returns over time. It's like having a safety net for your investments. There are various ways to diversify your investment portfolio. We've already discussed stocks and bonds, which are two primary asset classes. As your income grows, you can explore additional asset classes, such as real estate, commodities, or international investments, to further diversify your holdings. Remember, diversification is an ongoing process. As your financial situation and goals evolve, so should your investment strategy. Beyond stocks and bonds, there are other investment avenues to consider as you diversify your portfolio. One popular option is real estate. Investing in rental properties can provide both income and potential appreciation in value over time. Imagine owning a rental property where you receive monthly rent payments from tenants. This passive income stream can supplement your primary income and contribute to your overall financial well-being. Additionally, as property values increase over time, your real estate investment can appreciate, potentially generating significant returns if you decide to sell in the future. However, it's crucial to note that real estate investing also comes with its own set of risks and responsibilities. Being a landlord involves managing tenants, handling maintenance and repairs, and navigating the legalities of property ownership. It's essential to thoroughly research and understand the intricacies of real estate investing before taking the plunge. Besides real estate, you can explore other alternative investments, such as commodities or international investments. Commodities include raw materials like oil, gold, or agricultural products. Investing in commodities can be volatile, but can also provide diversification benefits as they often move independently of stocks and bonds. International investments involve investing in companies or assets outside of your home country. This can provide exposure to different economies and potentially higher growth opportunities. Diversification is about finding the right mix of investments that aligns with your risk tolerance, financial goals, and time horizon. It's always advisable to consult with a financial advisor who can assess your individual circumstances and recommend a personalized diversification strategy. Congratulations! You've taken the first step toward financial empowerment by learning about the basics of investing. Remember, investing doesn't have to be intimidating. Start by investing in yourself and building a solid foundation with an emergency fund. Then, explore simple options like low-cost index funds and consider diversifying as your income grows. The key is to start early, invest consistently, and be patient. Time is your greatest asset in investing, allowing the power of compound interest to work its magic. As you continue on your investment journey, don't hesitate to seek guidance from reputable financial advisors who can provide personalized advice based on your unique circumstances and goals. Investing is a journey, not a race. Steady steps today lead to lasting rewards tomorrow. Let's grow your money together, one smart move at a time. By taking small, consistent steps, you can build a secure financial future and achieve your financial dreams. Now, go out there and make your money work for you. If you're ready to take control of your financial future and grow your money with us, don't forget to hit that like button, subscribe to the channel, and turn on notifications so you never miss out on our tips and strategies. Your support helps us create more content to guide you on this exciting journey. Let's grow your money and this channel together.